Hi guys, and welcome to another video where we will be talking about first presented fair value gaps. Once again, very powerful concept that I just thought I should give another practical example of it. And we'll go through price action of this last Friday, April 4th, and you will see how the algorithm used all three first presented fair value gaps part of each New York session. So New York AM, New York lunch, and New York PM session. Each of these sessions have a first presented fair value gap, and we used each one of them in order to deliver the session's objectives. Okay, and just bear with me. I will go through each individual session and I will show you how, if you implement the model that I taught in my last video on how to trade first presented fair value gaps, um, you will find these really easy setups that will deliver so strong in your favor that your ass is gonna hit the floor. Okay, so without further ado, let's start with New York morning session. So starting from 9:30 all the way until 11:30. So starting at 9:30, after the market already dropped so much overnight, in fact, I think we dropped around what was it? I'm looking at the micro contract, and it dropped over 500 points overnight. And so we also didn't deliver the final weekly objective, which was the consequent encouragement of a daily week. So there is a daily low, um, and we were targeting the consequent encouragement of that low and ultimately the low itself. But for the morning session, we were targeting the consequent encouragement. More on that you can see. I'm not going to show it here for the sake of clarity on the chart, because this is not my main focus now. I want to talk more about the first presented fair value gaps. But if you want to see the objectives and everything, just check ICT's video on it. It's from last Friday, April 4th, where he goes through price action with specific targets, specific PD arrays and everything. And it will get more clear. So, but initially, what we are looking at, always at 9:30, you have to have the initial buy side and initial sell side liquidity. How do you determine that? Well, you take the range from 8 o'clock all the way until 9:30 here. So here. And within that range, there will be a low and a high, which will be our initial buy side and sell side liquidity levels that the algo will use in order to start the morning delivery. Okay. It will unsettle individuals that have stop orders around these levels. Okay. That's what the market wants to do initially: unsettle buyers, unsettle sellers, and then deliver the real move for the day. So here, though, initially you see on the sell side we have these relative equal lows. So these are a candidate. Whoever is long here, these sell stops below this level are a candidate to be attacked. Okay. On the buy side, however, the market didn't deliver to the high that formed at 905, so that was the highest high of this range. Why did we take just this intermediate high before dropping lower? Well, because this high at 905 already, if you go to the left, it already purged relative equal highs here. So there was a stop hunt already here. Yeah, sure, it's just 1 2 handles, but that is a stop run. Okay, so this high now is um, not that it cannot be taken, but the probabilities are lower. And if we take it, the market is likely to expand further up, okay, and go much higher. It's not going to stop here. It's going to go much higher, probably fill at least half of this opening range gap, and so on. But because this is already a run on stops, the market doesn't need to go there now. Okay, it only takes the intermediate high here, then one more poke into it before we drop. We form the first presented fair value gap, and it is used here at 10:05. So everything from 10 here, 10:05, and then we start dropping lower. Okay. Now, if you remember the logic that I explained to you on how to trade first presented fair value gaps, the conservative way. Um, so if you miss this entire move here, the conservative way is to wait for price once it displaces away from the first presented fair value gap. You would want to wait for price to go back to the first presented fair value gap and then fail to close above it. So this is a scenario if you're short, fail to close above it and then drop again, displacing out and away, leaving inefficiencies out and away from this first presented fair value gap. So this first displacement out of the fair value gap will be your high probability um, candidate for a short. Okay. And in this specific session here in the AM, we were not provided the opportunity to trade this way, the first presented fair value. After we displace here down, see on the way up here during the 1050 to 1110 macro, we reached for this inefficiency. So this is a inversion fair value gap now. You have here market structure shift, so high, higher high, then market structure shift with displacement. Okay. This inversion fair value gap, because there is a breaker next to it, and because there was an order block here, this order block is preventing us, or how to say, the algorithm doesn't need to reprice the first presented fair value gap before dropping lower because of this order block. Why? Well, if you look closer, you would see I mark here with darker red this inefficiency also. There is a volume imbalance. But if you look at this whole inefficiency, this range, or if you look at this CB, this whole range is inefficient only below the order block. Okay, so because here we have buy side delivery, we have sell side delivery. The inefficiency is here. So that's your inefficient range. So the market doesn't really need to go up to the first presented fair value gap because this whole range here is very much balanced. Okay, there is an order block preventing it from going up, so we are not allowed here to trade our model, the one where we retrace back to the first presented fair value gap of morning session, fail to close above it, then we displace lower. However, this inversion fair value gap does exactly that job for us. Okay, displacement here, and on the way back up, we fail to close above it on a closing basis, then we displace lower. So this inefficiency now is your high probability candidate to short the market. Okay, you can target these lows or here. In this specific example, you would want to not wait. I know this is hindsight, but if you're waiting for us to touch the CB, you're not going to get filled. So it's better here if you use the logic Michael explains, that you have to take your entry before price hits the CB. Okay, so your entry have to be outside. You might not get filled on this one. It's possible if you're trading on limit. If you try to time a market order, you will get filled, uh, probably somewhere down this week, but ultimately, yeah, you are going to be denied this as well. However, even if you couldn't capitalize on the entire morning session, these two setups, we then have the launch macro, starting from 11:30 all the way until 1:30. The launch macro has its own first presented fair value gap, and it's the first gap after 11:30. Yeah. I know Michael didn't speak about it, but it's there. So if you just follow on what Michael is teaching, it's logical. It's there. Okay. Don't take my word for it. Go on, test it on your charts, and see for yourself. First presented fair value gap after 11:30 is the launch gap, which will be utilized for um, the launch objective and could be utilized later on during the PM session as well. And I'll show you what I mean. Now, the launch provided a very nice setup. I mean, the launch first presented fair value gap provided exactly the setup that I was teaching you in the last video. By the way, once again, I'm leaving a link in the description to that video where I'm showing you how to trade first presented fair value gaps conservatively. And here I'm showing you the exact same logic and how it works. Okay. Once we have that gap, price starts working that gap here all the way until 12:15. Then it starts delivering down. It drops all the way to here at 1:15 when it takes the morning low and starts retracing. Then from 1:30 to 2 o'clock, you want to check the first presented fair value gap of the PM session. Okay, it's this purple one. It's not this small one here, because as Michael said in his video, if the gap is too small and insignificant, you want to look for the next well-defined larger gap. Okay, it's this one. So you use that one. Okay. But back to the first presented fair value gap of launch. So here is the model. Displacement. Then price goes back up. See when we start spooling towards it. Pay attention to this. At 1:30, we spool back to the first presented fair value gap of launch. We stop to the midpoint of the gap. See, bodies stay below it. You know, the bodies tell the story, the wicks do the damage. They don't do too much damage here though. But anyway, then we fail to close above it and we displace again away from it, forming this fair value gap. This fair value gap, after it does that, this is your candidate for high probability short. This is your institutional order flow entry drill. Okay. And see how aggressively price starts to deliver down, taking the launch low. There is another important thing that is happening here. If you pay attention, this high and this high, they're relatively equal. If you watched Michael's explanation on the Venom model, you would know that if we take these relative equal highs with an inefficiency, so there is a BC on the way up, we close above them, and then we go down, changing market structure shift here under this low, and leaving a CB. So it's reciprocal to whatever happens on the left happens on the right. Okay, leave a CB. That's high probability market structure shift. It's a confirmation that this is a stop hunt and we are about to go down. The first presented fair value gap of lunch is another confluence for you here. So see how all these things, they blend together and they show you the way. So the way is down. Okay. We go down. Pay attention to what happened here because the same thing, yes, you guessed right, will happen during the PM session, first presented fair value gap. We trade back to it from 315 to 345 is a macro which usually is used to accumulate before the final macro from 345 to 4 o'clock starts delivering. So back to the first presented fair value gap of the PM session, failure to close above it, see, we feel that perfectly with the bodies, but we failed to close above it. This is an indication. Once we displace again away from it, the first step into an inefficiency is your institutional order flow entry drill right here. Okay. And you can target these relative equal lows and ultimately the daily low that was actually not reached during Friday. It was reached during once we opened on Sunday, if I'm not mistaken. Actually, the market gapped. I think it gapped maybe lower than that daily low. I'm not quite sure on that. You go check it out. But these lows will be my target for that delivery. Also, I like to be out by 4 o'clock. So 4 o'clock will be here. This green candle. I like to be out at this point. Okay, I don't want to stay beyond 4. But zooming out, do you see how the model delivers? Launch gap, away from it, back to it, failure to close above it, then displacement. Institutional order flow entry drill, which by the way was a setup that I took a little bit late as I didn't see it immediately. I wasn't on the chart, so I missed on the initial entry. Then down. Here was my exit. Then same with the first gap of the PM session. Back to it, failure to close above it, displacement, institutional order flow entry drill, and then down. Okay, see, that is the model, guys. Very high probability. If you blend with the right narrative and time of day, so pay attention. These things happen during macro windows. It is super effective. The stop losses are very favorable, meaning they are relatively small compared to your return. So if you manage risk properly, you can get massive gains. Okay. Anyway, I just wanted to show this example how these gaps can deliver sometimes give multiple setups during the day. Well, let me know how they work for you. Do you use them? Do you use them in some other way that I've not yet explained. I'll be interested in seeing that. What other way you have of using these gaps? How do you find your entries around them? Okay, feel free to comment. If you're new around here, please subscribe to the channel, help me build an audience, and like this video, of course. And until I speak to you in the next one, I am out of here.